You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. It's January 15th, 2025, and we are looking at the behemoth itself, BlackRock. They just dropped their fourth quarter results for 2025. Just a quick heads up before we start, nothing we say here is financial advice. We're just two friends trying to make sense of the numbers. So, Miro, $14 trillion. That is, frankly, hard to even visualize. It feels like they're not just managing the market anymore. They are the market.
Yeah. 14.04 trillion in AUM, to be precise. It's basically the GDP of the Eurozone. But look, the headline numbers were solid across the board. Adjusted EPS came in at $13.16 a share, which is a nice jump from $11.55 last quarter. Revenue hit $7.01 billion, up from $651 billion in Q3. And margins, they actually expanded a bit. Operating margin ticked up to 45% flat compared to 44.6% previously. So pure execution.
45% operating margin. I mean, most software companies would kill for that. And this is an asset manager. But the number that jumped out at me wasn't the EPS. It was the flows. Did I read that right? $342 billion came in the door in 3 months.
You read that right. $342 billion in total net flows. To put that in perspective, they basically absorbed more assets in 90 days than most of their competitors manage in total. And that's really what drove the stock today. You saw the price action, right? It's been a pretty messy quarter for them. The stock was down about 6% over the last 3 months. Really volatile, dipping under 1,000 back in November. But today, different story. Opened around 1128, shot up to the 1150 level almost immediately. The market clearly decided the bleeding was over.
Yeah, it felt like a sigh of relief from the street. Like, okay, the machine is still working. But, hearing those flow numbers, there's a quote from the CFO that stuck with me. He said, it's not that the big are getting bigger, it's that the best are getting bigger, which, I mean, that is a very BlackRock thing to say. A little bit of a flex, don't you think?
A huge flex. But honestly, the data backs him up. This isn't just passive flows into cheap ETFs. They mentioned fee yields on new assets are 6 to 7 times higher than they were in 2023. So they're not just vacuuming up cheap beta, they're getting paid for it. That's the scary part for everyone else. They're winning on scale and on pricing power in these niche areas like private markets.
Right. It's not just a vacuum cleaner. It's a very expensive, high-margin vacuum cleaner. Although I did notice one little detail that felt less perfect. The tax rate. They had a nice tailwind this quarter, 20.2% effective tax rate, but they're guiding for 25% next year. That's a pretty steep math problem for 2026 earnings growth, isn't it?
That's sharp catch, yeah. 20.2 is, let's call it helpful. When that normalizes to 25, the EPS comparisons get a lot tougher. But here's the counterbalance. They also said they expect headcount to be broadly flat in 2026. Think about that. They just bought HPS. They bought GIP. They're integrating Preqin. And they're not adding net new bodies. That's ruthless efficiency.
Flat headcount while digesting huge acquisitions. That is, ruthless is the word. It feels like they're trying to build a machine that scales without friction. All right, let's get into the details. There is a lot to unpack here, especially regarding this private market strategy.
Let's do it, because I think Larry Fink is trying to index the un-indexable.
Indexing the un-indexable. That sounds like a tagline for a sci-fi movie, Miro, or maybe a threat. What does that actually look like in practice? Because private equity is, private. It's messy, it's opaque, deals happen behind closed doors. How do you slap an index on that?
You do it by owning the ruler. Look, they bought Preqin back in March for a reason, and it wasn't just to sell data subscriptions. On the call, Larry basically laid out the blueprint. He wants to use Preqin's data plus Aladdin's risk engine to build the machine for indexing private markets.
Build the machine.
Exactly. Think about what iShares did for bonds 20 years ago. Before that, the bond market was fractured, illiquid, hard to trade. BlackRock standardized it, wrapped it in an ETF, and suddenly you could trade corporate debt like you trade Apple stock. So now they want to do the exact same thing for private credit and infrastructure.
So effectively, they want to turn private equity into a commodity? Like strip away the mystery and just make it a ticker symbol?
That is the end game. If you can standardize the data, you can create a benchmark. If you have a benchmark, you can create a passive product. And if you create the passive product, you own the liquidity for the entire asset class. It's honestly, from an engineering standpoint, it's brilliant. It's creating a market where none existed.
It's brilliant, sure, but it also feels a little audacious. Like, we're just going to rewrite the physics of how private companies are valued.
Audacity is their business model, Susie. But here's why they're doing it. And this is the part that really changes how I view their growth. Did you catch the stat the CFO dropped about fee yields?
I saw something about fees going up, which honestly in this industry, usually fees go down.
Right. The narrative for the last decade has been fee compression. Everyone is racing to zero on ETF fees. But get this, the fee rate on the new assets they brought in this year was 6 to 7 times higher than the flows they saw in 2023.
Wait, 6 to 7 times higher?
6 to 7 times higher, because the growth isn't coming from the cheap S&P 500 trackers. It's coming from these private markets, from active ETFs, from the complex stuff that only they have the scale to standardize.
That actually explains the flat headcount. They're swapping out cheap, labor-intensive assets for high-fee, technology-driven ones. It's not just getting bigger, it's getting denser.
Denser is a good word. But look, I have to be the buzzkill for a second. There is a risk here.
There it is. I was waiting for the other shoe.
Well, you can index the market, but you can't index away the credit cycle. Management was surprisingly blunt about this. They explicitly said the era of very low defaults in private credit is over. They're expecting a catch-up period.
A catch-up period. That's a polite way of saying companies are going to start going bust.
Precisely. They claim HPS, their private credit arm, is focused on bigger, safer companies, so they're insulated. And maybe they are. But if you're trying to build an index for an asset class right at the moment that asset class starts cracking, that gets messy. You can't just algo trade your way out of a default cycle.
Right. It's one thing to sell an index of the S&P 500 when stocks go down. People get it. It's another thing to sell an index of private loans when the borrowers stop paying. That feels sticky.
Very sticky. And don't forget, they also took a $115 million hit on their Circle investment this quarter. That's crypto volatility sitting right there in the non-operating income.
Oh, the mark-to-market loss?
Yeah. It's small relative to the whole, but it's a reminder. When you start expanding into everything, private credit, crypto stakes, infrastructure, you import the volatility of everything too. You're not just an observer anymore. You're the sponge absorbing the shocks.
A sponge absorbing the shocks. That is a vivid image, and probably an expensive one if they get the risk models wrong.
If Aladdin gets the risk models wrong, Susie, we have bigger problems than BlackRock stock price.
Fair point. If Aladdin breaks, we're all probably trading canned goods. So, yeah, let's step back for a second and think about what all this means going forward. Let's hope Aladdin keeps the lights on then. I'd prefer not to trade my savings for beans just yet. But seriously, stepping back from the doomsday scenarios, what does this quarter actually signal for the rest of 2026? Because to me, it feels like they're making a massive macro call here.
They are, and they were pretty explicit about it. They're calling the top on the cash era. You know, for 2 years, everyone's been happy sitting in money market funds, earning 5% risk-free. BlackRock is saying that's over. The yield curve is steepening, and that money has to move.
Right. The great reallocation. They're positioning themselves to be the bucket that catches all that splashing water.
Exactly. And that's why the strategy is shifting from just gathering assets to building the infrastructure. But look, looking ahead, the next few quarters aren't going to be a victory lap. They have a real math problem to solve.
You mean the tax rate?
The tax rate, yeah, going from 20% back up to 25% is a nasty headwind for earnings growth next year. But it's also the execution risk. They have to integrate HPS, GIP, and Preqin, three massive, distinct cultures, while keeping headcount flat. That is a tightrope walk.
It's the do more with less mantra, but on a $14 trillion scale.
Right. If they pull it off, they become the operating system for global finance. If they stumble on the integration, that stock premium vanishes fast. So next quarter, I'm not looking at the AUM number, I'm looking at expenses. I want to see if the machine is actually as efficient as they claim.
Well, if anyone can automate their own existence, it's probably Larry. It feels like we're watching a new chapter of finance being written in real time.
Or at least indexed in real time.
Touché. All right, that's a wrap on the analysis. Stick around for a quick word on how we put this whole thing together.
See you on the other side.
So before we sign off, I want to take a second to pull back the curtain. What you've been listening to, this whole conversation, me, Miro, the deep dive into private markets, is actually an experiment. Earnings Unscripted is a project built by a small team of enthusiasts who are trying to map the frontier of AI. Basically, this episode was created by a squad of AI agents, from the research analyst parsing the PDFs to the script writer drafting our lines, and even a QA specialist keeping us honest. The idea isn't to trick anyone. It's to explore how these tools can enrich us, helping us deliver high-density, up-to-date information that would be incredibly difficult to produce this quickly otherwise. We are very much still in the learning phase, so we'd love to know what you think. Did it work? Did we sound, well, human enough? Drop the team a line at earningsunscripted@datamadness.ca or follow the project on X. Thanks for trusting us with your time today.
Yeah. See you after the next goal.